We're going to go over three things here in this video. Number one, jobs report that just came out this morning and what implications this could have for the markets coming on Monday. Because if you have not seen, futures did open, so we have a slight indication of how investors were feeling, but we're not trading today because this is Good Friday. Easter is on Sunday. Second thing we're going to cover, the AMC Ortex data and the bearish option flows that have been happening with AMC. Number three, how one longtime investor thinks the stock market is about to drop 50% in a worst case scenario. So, if you're not excited, well, I don't know what gets you excited early in the morning. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. Now, if you guys also want to trade with me live in real time as well, link down below in the description. We are all on it when it comes down to a stock market crash. You will be in a very good position if you are in that community. And thank you guys for those of you guys that are. It's a great place to be every single day. So now let's get into this jobs report, okay? Let's talk about it. So job growth totals 236,000 in March, near expectations as hiring pace slows. Non-farm payrolls grew by 236,000 for March compared to the Dow Jones estimate for 238,000 and below the upwardly revised 326,000 in February. The unemployment rate ticked lower to 3.5% amid an increase in labor force participation against expectations that it would hold at 3.6%. Now, when futures open, they only open for a couple minutes here. NASDAQ was the underperformer, and it was up about 0.1%. S&P up almost 0.25%. The Dow up 0.19%. But what is interesting about this is bonds actually went higher. So bonds going higher like this, granted, they have been going lower recently, and that is because of multiple reasons. Some investors thinking the Fed's going to cut rates in 2023. Some people think inflation going down. Some people think the economy worsening. Well, this is kind of showing the Fed's going to have to do more, right? They're not going to be able to cut rates as quickly as investors would have hoped. So that's why you're getting the bonds going higher. I don't even really care about futures, that they were green. That doesn't matter to me. I don't care at all. I want to look at the bond market. And the bond market going up 8 basis points is a pretty substantial move. And it's telling you the Fed's not going to be able to cut. The economy, maybe it's okay, at least for now. So that's key, and I think that's telling. And I think coming on Monday, investors are probably not going to be super bullish. Now, mix that with the upcoming CPI report on Wednesday, bank earnings that start next week as well as the Fed minutes. Yeah, there's going to be a lot of reasons next week to be bearish heading into the week as well. So I do expect strongly that Monday is going to be a red day. Now, by how red it is, we'll see. Those data points like CPI will be of the utmost importance. So that's the first thing. Second thing is going to be the Ortex data on AMC and the bearish option activity. So what you've seen yesterday was actually remarkable. 305 institutional orders totaling $98.5 million with a positive order value of 2%. This means that out of $100, $2 was bullish, $98 was bearish. And you had a lot of option activity. $98.5 million is a good week for AMC, and that happened all yesterday. So I think really people are speculating here in a huge way. People are off sides here. If you get the courts that say, we're going to need another court date, or we're going to need to find a different settlement, right? Something that's more equitable and fair for all AMC common shareholders, or if the judge says there needs to be another vote to see if shareholders agree with the settlement. Point being here, there's a lot of different things that could potentially happen that could be negative for this arbitrage trade, which could squeeze these shorts out of these positions, or cause, in other words, AMC stock to go higher. When you're seeing this kind of derivative exposure to the negative side, that hurts a lot if you get a positive reaction in AMC. And I personally think this isn't going to be over on April 27th. I could be wrong. Who knows, right? We've been surprised before many of times. But I think there's going to be at least one more court date. And I think that does spark a very bullish rally in AMC stock. And I think people will come to the harsh reality that this trade was never as simple as they thought it was going to be. What do they expect? They're going to get squeezed out of their short positions very, very shortly, in my personal opinion. If you take a look at the numbers here, 25.12% short interest of free float, about 130 million shares currently sold short. Cost to borrow rates are about 1,000% across the board. Cost to borrow max at over 1,000%, 1,050%. Earlier in the day, yesterday, or today, really, you've seen the cost to borrow average at about 920%. Cost to borrow average was sitting at about 8% all day yesterday. Now, Interactive Brokers, short availability, which is interesting. The last update that we got yesterday was 778.7%. That's insane, because Interactive Brokers really favors your institutional clients that are generally going to get the best deals on shorting stocks. So if you're seeing these cost to borrow rates 700-800%, that's huge. If you look at the cost to borrow rates, the one report that we got here today, that was 390%, with 200,000 shares that are available to be lent out. So that is absolutely out of this world, insane numbers, and definitely not helping the shorts by any stretch of the imagination. So that is number 2. Number 3, brace for the S&P 500 to plunge 50% and a painful recession to strike as the everything bubble burst, elite investor Jeremy Grantham warns. And he says the S&P could go to 2,000 points in a worst-case scenario. Grantham advised against betting on U.S. stocks for the short term and touted emerging markets. Jeremy Grantham has warned the implosion of an everything bubble could tank the S&P 500 by up to 50% and plunge the U.S. economy into a painful recession. The prices of stocks, bonds, real estate, fine art, and other investments ballooned to unsustainable highs during the pandemic, Grantham said. The market historian and GMO co-founder shared his thesis with economist David Rosenberg during a recent Rosenberg Research webcast. The current bubble is pretty damn big, quote, compared to previous ones, and dwarfs the dot-com boom in scope, Grantham said. Quote, it's bad enough just doing the equity market in 2000, he said. This time, we have done a dead ringer for the equity market. Plus the gravy, we've done the housing market and the bond market. So he's basically saying everything is in a bubble and ready to implode. Quote, be advised, this is not a gentle setback like 2000, Grantham continued, predicting a bear market could persist until deep into next year. He noted the dot-com crash only caused a mild recession, but even so, the NASDAQ index plummeted 82%, and the S&P 500 halved in value during that period. The bubble expert predicted that if the U.S. gets lucky, the S&P 500 might slump by around 24% to roughly 3,000 points. If events pan out poorly, the benchmark index could tumble below its pandemic low to around 2,000 points. He warned. Grantham said a recession is inevitable when a super bubble does pop. And the ensuing downturn is worse when the speculative frenzy affects multiple asset classes. He also noted to the current banking crisis, noting that the U.S. credit markets might come under pressure from high levels of debt and rising interest rates. That could worsen the fallout from the asset bubble bursting, he said. And I do want to make a quick note on that really, that's a problem, right? The credit markets overall, not just because the banking crisis, but because investors have been so used to cheap money and essentially free money for so long. When you jack up interest rates this quickly, a lot of people don't know how to deal with that, right? A lot of even companies don't know how to deal with that. Look at Virgin Galactic that literally just went bankrupt. They didn't know how to deal with, 5% federal funds rates. That's happening across the board. Commercial real estate, not in a good place, right? Look at the UK's pension fund, right? The bonds, that was caused by the bonds. People just don't know how to operate anymore in a 5% interest rate environment, especially when you start to get economic pain and worries. That's where you start to get a problem in the credit market. And the credit market is very, very important. Now, continues on to say the veteran investor predicted rising unemployment, slowing growth, and slimmer corporate profit margins from May onward. But he emphasized that economic fundamentals can deteriorate for years before they finally bottom out. Grantham also offered some advice to investors on how to weather the upcoming storm. He cautioned against short-term wagers on U.S. stocks, touted emerging markets as relatively cheap, and recommended betting on long-term trends such as climate change and resource shortages. Quote, "If you want to have U.S. equities because you have to, then for heaven's sake, play the long game and do resources and climate change and pretty well stay away from everything else," he added. So that's a bold assumption, and you're starting to get a lot of people talking about a big stock market crash, and I am in that camp. Although it's hard to forecast when that will happen, because markets typically don't happen as you would have expected them to happen. It could be over the next couple of weeks. It could be markets get spooked if earnings are worse than expectations. That is ultimately what leads stocks to crash, is actual earnings going down. The Fed raising rates and the markets being panicked in 2022. Yeah, why were they freaking out? Well, it's because ultimately people think earnings were going to go down. Recession was going to come. Now you're getting to that make or break it kind of point where throughout 2023, but really here and now, you're going to start to get some implications for margins going down, overall profits going down, and it might be pretty ugly. Think just to 2 weeks ago when Micron reported earnings. Their revenue dropped like 30%. Their earnings dropped like 30%. They lost billions and billions of dollars. It was the worst quarter they've ever had. And, I mean, the stock still went up 10% because people are like, hey, they're bottoming out. But what if Apple and Google start to show some very bad numbers? That's not going to be a good thing. So why I bring this up, specifically if you guys are traders and you're looking to trade this, obviously you guys know you can make a lot of money if you're right when the markets crash. If you guys want access to my trades in real time, link down below in the description of this video. We will not miss the crash. I'll tell you that one. Obviously not a guarantee. I'm not a financial advisor, but we will not miss the crash in 2023. Now, at least watching it very closely every single day, it would be hard to miss the crash, essentially, is what I'm saying. Now, I say this specifically and bring this up here in this video because collateral that is backing the AMC short positions is very important. If you start to get stocks like these stocks right here on the side, Netflix, Microsoft, Apple, Tesla, that really start to fall, that is not a good thing for those shorts in their AMC short positions, because short positions have unlimited risk. So when your collateral drops and you're off sides there, people that, banks usually, right, brokerages, they just call up the hedge fund, say, we need more collateral. Your collateral just halved in value, or lost 20%, 30% in value. We're going to need some more of that. And if they don't have collateral, or they don't have the cash to put up in those margin accounts, essentially, then you start to get margin called. You start to get forced share liquidations. You start to get forcefully closed out of your positions. And especially when the markets are in turmoil and falling, that's where things get very dicey very, very quickly. And really over the next couple of months, if the judge does give us one more court date, which I do think they will, that could be setting up right around the time coming early June when markets could start to feel a lot of pain. That's kind of my expectation. You're going to get a lot of your companies that will have reported earnings by the end of April, but by the second half of May. So really by second half of May, early June, that's when you could be in the gulag for the market if it's going to happen this earnings season. That's the time period that I would think the markets would start to crash or would be already crashing at that point. So that is going to do it for this video, guys. Hopefully you learned something. If you did, hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you guys want to get totally free stock with Webull, Moomoo, or Public, link down below in the description of this video. Specifically Public and Webull, I've been using them quite a bit. Moomoo's okay as well, but I mean, you know, you got to be careful with where you put your money in 2023. I think that's an obvious one. So thank you guys for watching again. Enjoy your Good Friday, and I will see you in the next one.